Imagine waking up tomorrow and realizing your income hasn't changed, but your freedom has quietly shrunk. Your paycheck comes in, your bills go out, nothing unusual, except this time, more of that money is already spoken for, promised, locked, owed. That's the strange thing about debt. It doesn't feel dangerous at first. It feels useful, convenient, even empowering, until it isn't. Debt is often sold as a tool. A mortgage gets you a home, a loan starts a business, a credit card smooths out emergencies. Entire economies run on it. Governments issue it, corporations depend on it, households normalize it. And most of the time, it works. But beneath that smooth surface are three quiet risks, three structural reasons why debt can turn from helpful to hazardous, not just for individuals, but for entire systems. The first danger is simple. Debt removes your future options. When you borrow, you're not just taking money, you're committing your future income to a decision made today. You're placing a claim on tomorrow. Let's say you take a 5-year loan. Every month, a portion of your income is no longer flexible. It's fixed. Whether you like your job or not, whether the economy slows or not, whether your industry changes or not. Debt hardens your financial life. On paper, the payment might look manageable, but life rarely moves in straight lines. Jobs disappear, health changes, markets shift, and when income drops, debt doesn't politely step aside. It demands priority. This is why heavily indebted households feel stress long before they technically default. Their margin for error shrinks. Their ability to take risks, change careers, start something new, move cities, quietly fades. Now zoom out. The same logic applies to businesses. When companies load up on debt during good times, profits look stronger, growth accelerates, investors celebrate. But those debt payments remain fixed. If revenue slows even slightly, pressure builds quickly, layoffs begin, projects freeze, expansion stops. Debt reduces flexibility, and in uncertain environments, flexibility is survival. That's the first danger. The second is more subtle. Debt amplifies cycles. When borrowing is cheap, people borrow more. When interest rates are low, mortgages surge, asset prices rise, companies expand aggressively. Everything feels upward and energetic. Debt fuels momentum. But here's the catch. Momentum works both ways. Because the more leverage in the system, the more sensitive it becomes to small changes. Imagine interest rates rise by just 1 or 2%. On a small loan, that might seem trivial, but across trillions of dollars in mortgages, corporate bonds, and government debt, that shift multiplies. Monthly payments increase, refinancing becomes harder, investors demand higher returns, asset prices wobble. What looked stable begins to tremble. This is why debt-driven booms can feel unstoppable right up until they don't. The very force that accelerated growth becomes the force that accelerates decline. We've seen it before. Housing markets inflated by easy credit, corporate expansions funded by cheap loans, entire sectors built on the assumption that rates would stay low forever. Then conditions change, and suddenly, balance sheets that looked strong reveal a different story. Debt magnifies gains, but it also magnifies fragility. The third danger is the most uncomfortable. Debt creates dependency. When an economy becomes heavily reliant on borrowing, it needs constant expansion to remain stable. Think about the mechanics. Debt today is justified by income tomorrow. Growth is assumed. Revenue is projected. Tax collections are forecasted. But what happens if growth slows? If incomes stagnate, yet debt keeps compounding, the system becomes strained.
Governments roll over old debt by issuing new debt. Companies refinance loans instead of paying them down. Households move balances from one line of credit to another. The system doesn't collapse instantly. It adapts, it extends, but it becomes dependent on favorable conditions. Low rates, strong growth, willing lenders. Remove one of those pillars and pressure builds quickly. This is why central banks pay such close attention to credit conditions. Tighten too aggressively and defaults rise. Ease too much and bubbles form. It's a delicate balance. And here's the irony. Debt is not inherently evil. It's not automatically reckless. It's not something to fear blindly. But it is a commitment to a future you cannot fully control. And when too many commitments stack up at the household level, the corporate level, the national level, small shocks can create outsized consequences. The question isn't whether debt will always exist. It will. The real question is this: how much future are we quietly trading away in exchange for today?